Okay, so next, let's zoom out and look beyond the company itself. Even a great business can struggle in a weak industry, so this is where market and industry outlook comes into play. First, analysts evaluate the company's market position and competitive standing. They might ask questions: does it have a strong brand recognition? What's the pricing power? What are some of the barriers that make it hard for new competitors to enter? So then comes growth and scalability. How fast has a company grown historically? How big is the future opportunity? A company in a growing market usually has more room to expand than one stuck in a mature or declining industry. Margins matter here too as well. Comparing gross, operating, and free cash flow margins against peers help determine whether a company is outperforming or lagging behind competitors. Industry trends are also critical. Is the business cyclical, highly regulated, at risk of disruption from new technology? These factors can drastically affect a business long term. Finally, analysts also look at valuation multiples, like price to earnings, enterprise value, EBITDA, or price to sales, and compare them to peers. If a company trades at a premium, the key question is why. Is it justified by better growth, stronger margins, or lower risk? So valuation isn't just about the company, it's about the bigger picture and the industry that it performs in. So now let's talk about one of the most important concepts, which is competitive advantage. Basically, it answers the question, what stops competitors from copying this business? Competitive advantages can come from many places, cost leadership, pricing power, strong branding, switching costs, network effects, scale, intellectual property. But having an advantage isn't enough. The real key is sustainability. Can this edge last 5, 10, 20 years? Or is it going to be something that competitors can easily catch up? Customer loyalty plays a huge role here. Repeat customers, long-term contracts, and ecosystems lock in all signal that customers aren't likely to leave when a computer offers a slightly cheaper option. This is also where differentiation matters. What makes this company different? Why do customers choose it over alternatives? Investors generally are willing to pay higher valuation for companies with strong defense competitive advantages because they offer more predictable cash flows and long-term growth. So now let's talk about something that doesn't show up directly on financial statements, but matters just as much, which is management and capital allocation. At the end of the day, companies don't make decisions, people do. The first thing investors look at is the quality of management. Do they have a strong track record? Have they made smart decisions over time? Are they honest and transparent with shareholders, especially when things don't go as planned? So if we have a look at capital allocation, which is how management uses the company's profits, do they reinvest back into the business to fuel growth? Do they reduce debt or return money to shareholders through dividends and buybacks? One key metric here is return on invested capital, which measures how effectively management turns invested money into profits. Consistently high return on invested capital signals that leadership knows how to deploy capital. Incentives matter too. So are executives compensated in a way that aligns with long-term shareholder value? Do they own stock themselves, or are they rewarded for short-term results? Strong management teams are good stewards of the balance sheet. They avoid excessive leverage, prepare for downturns, and communicate clearly and realistically with investors. When you invest in a company, you're trusting management with capital, so who's in charge matters more than a lot of people realize.